Welcome back to Price Action Framework. Some shooting stars trigger major reversals, others fail completely. Today you'll learn why. Let's get started. Let me ask you a question. Imagine you are watching this chart in real time. Two shooting star patterns appear near the upper boundary of a channel. Would you sell immediately? Would you wait for confirmation? Or would you ignore the signal altogether? Keep your answer in mind. We'll revisit this chart later in the masterclass. Most traders treat a shooting star as an automatic sell signal. They see a long upper shadow and immediately assume the market is about to reverse. But this is where most traders get it wrong. They believe a long upper shadow automatically means sell. They assume every shooting star must lead to a reversal. And they think one candle alone is enough to make a trading decision. The reality? Not every shooting star works. A shooting star is simply a warning sign. It tells us that bullish momentum may be weakening, but it does not guarantee a reversal. Whether price actually reverses depends on three key factors: context, confirmation, and location. Let's first understand what a shooting star really is. Before anything else, remember this: a shooting star is only meaningful when it forms after an uptrend. Without an uptrend, there is nothing to reverse. This is one of the most common mistakes traders make. They focus on the candle itself and ignore the trend that came before it. If there is no prior uptrend, the pattern loses much of its significance. So whenever you see a shooting star, the first question is not, how does the candle look? The first question is, did it form after an uptrend? Now let's take a closer look at the anatomy of a shooting star. A valid shooting star consists of three key characteristics. First, a small real body. Second, a long upper shadow. And third, little or no lower shadow. Notice how the upper shadow is significantly larger than the real body. As a general guideline, the upper shadow should be at least twice the size of the body. This long upper shadow tells us that buyers were initially able to push prices higher. However, they failed to maintain control. Sellers stepped in and pushed the price back down before the candle closed. As a result, the candle closes near the lower end of its range. The longer the upper shadow, the stronger the rejection of higher prices. This rejection is what gives the shooting star its bearish warning signal. Together, these characteristics create the classic shooting star formation. Before you label a candle as a shooting star, make sure it meets several important criteria. First, it must form after an uptrend. Without an uptrend, there is no bullish momentum to reverse. Second, the upper shadow should be at least twice the size of the real body. Third, the real body should remain relatively small. And finally, there should be little or no lower shadow. If one or more of these conditions are missing, the pattern becomes less reliable. Remember, not every candle with a long upper shadow is a valid shooting star. Understanding these criteria will help you avoid low-quality setups and focus only on higher probability formations. But there is another question many traders ask. Does the color of the shooting star matter? Many traders believe a shooting star must have a red body, but that's not actually true. A red-bodied shooting star is generally considered slightly more bearish because it closes below its opening price. However, a green-bodied shooting star can still be a perfectly valid bearish reversal signal. What matters far more than candle color is the structure of the pattern and the context in which it appears. Remember, a shooting star is a warning signal, not a trading signal by itself. That's why professional traders focus on three things: location, context, and confirmation. In other words, don't reject a setup simply because the candle is green. Focus on the story behind the candle, not just its color. Because in trading, context is primary and color is secondary. Now that we understand what a valid shooting star looks like, let's look at what is actually happening behind the pattern. Because a shooting star is not just a candlestick. It represents a battle between buyers and sellers. At the beginning of the session, buyers are in control. They continue pushing prices higher and eventually create a new high. At that moment, everything appears bullish. Many traders believe the uptrend will continue. However, sellers begin to step in aggressively. Buying pressure starts to weaken, and sellers push prices back down. By the close of the session, much of the earlier bullish progress has disappeared. This creates the long upper shadow that we see on the chart. In other words, a shooting star represents a rejection of higher prices, and that rejection is often the first warning sign that bullish momentum may be fading. But remember, a warning sign is not the same as a trading signal. A shooting star tells us something has changed, but it doesn't tell us whether the market will actually reverse. So how do we know whether a shooting star is likely to work? Let's go back to the chart from earlier. We've learned what a shooting star looks like, we've learned how to identify one correctly, and we've learned the psychology behind the pattern. Now it's time to apply what we've learned. We have two potential shooting stars. At first glance, they look very similar, but appearances can be deceiving. Are they equally strong? To answer that question, we'll evaluate each setup using 4 key factors: structure, location, context, and confirmation. Let's find out. Before we begin, notice that I've hidden the candles that formed after the shooting star. This allows us to evaluate the setup exactly as traders would see it in real time. No hindsight, no future candles. Let's start with shooting star number 1. We'll evaluate it using the checklist we learned earlier. First, does it form after an uptrend? Yes, price has clearly been moving higher before the pattern forms. Second, does it have a long upper shadow? Yes, the upper shadow is significantly larger than the real body. Third, does it have a small real body? Yes. And finally, does it have little or no lower shadow? Yes. Based on our checklist, shooting star number 1 meets all the requirements of a valid shooting star. But remember, structure is only the first step. A valid shooting star does not automatically mean a high probability trade. We still need to evaluate the location, context, and confirmation. Let's look beyond the structure. A valid shooting star is only the starting point. To evaluate the quality of a setup, we also need to consider 3 additional factors: location, context, and confirmation. First, let's look at the context. Shooting star number 1 forms after a strong bullish advance. Price has already moved significantly higher before the pattern appears. This suggests that buyers may be becoming extended. Now let's look at the location. The pattern appears near a potential resistance area. That immediately makes the shooting star more interesting. However, one important question remains. Is this also a channel resistance area? At this stage, we don't know yet. And finally, confirmation is still missing. All we have right now is a warning sign. We do not yet have proof that sellers have taken control. So while the setup is becoming more interesting, it is still not a trade signal. We need confirmation before considering a trade. Now let's look at shooting star number 2. At first glance, it appears very similar to shooting star number 1. Structurally, it is also a valid shooting star. However, there are several factors that make this setup more interesting. At the time the pattern formed, we could already see 2 important clues. First, it appeared near a resistance area. Second, it formed right at the upper channel boundary. Those factors immediately made the setup more attractive. Now let's reveal what happened next. Notice how sellers quickly take control and push the market lower. Instead of moving sideways, price declines almost immediately. This strong bearish follow-through provides confirmation that sellers have taken control. In other words, the market is no longer treating this as a simple warning sign. The bearish pressure is now being confirmed by price action. Let's summarize what we've learned. On the chart, we can see a valid shooting star near the top of the move. It forms after an uptrend. It has a long upper shadow, a small real body, and very little lower shadow. So structurally, it qualifies as a valid shooting star. However, structure alone is not enough. Notice that not every candle with a long upper shadow automatically qualifies as a valid shooting star. And even a valid shooting star is not automatically a high probability setup. That's why. Throughout this lesson, we've used a simple framework. First, evaluate the structure, then the location, then the context, and finally in the confirmation. Many traders stop at structure, but professional traders evaluate the complete picture. Remember, a shooting star is a warning signal, not a trading signal. The pattern gets your attention, but location, context, and confirmation determine whether the setup is worth trading. And that's what transforms a valid pattern into a high-probability setup. In this lesson, we learned how to identify a valid shooting star We covered its structure, its psychology, and the criteria that define the pattern. But identifying a valid shooting star is only the beginning. As you've seen throughout this lesson, the real power of a shooting star comes from three additional factors: location, context, and confirmation. These are the factors that separate average setups from high-probability opportunities. And in Part 2, we'll go much deeper. You'll learn how to identify channel resistance, how to use Fibonacci confluence, how to find confirmation entries, and how to recognize higher probability shooting star setups before the move happens. Because in trading, the pattern itself is only one piece of the puzzle. What really matters is where it forms, the context behind it, and whether the market confirms it. If you enjoyed this masterclass, make sure to subscribe to Price Action Framework, and I'll see you in Part 2.